Over the past couple years, real estate trusts have been under attack. Share prices are dropping, dividends are getting cut. On the surface, it looks like all hell is breaking loose. For some poorly managed REITs, this is warranted. For others, it opens the door for savvy investors to get into high-quality companies with solid financials at rock-bottom prices. Some of the REITs we're going to look at today have paid consistent and growing dividends for over a decade but are still trading at all-time lows. Let's take a look at the highest yielding REITs on the market and make sure you stick around till the end to see the highest yielding REIT trading almost 90% down from its all-time high. First on our list is Two Harbors Investment Corp. TWO. TWO is a real estate investment trust that focuses on financing, managing, and investing in residential mortgage-backed securities and mortgage servicing rights. The company's business operations revolve around the management and optimization of its portfolio of mortgage-related assets. As a REIT, TWO generates revenue primarily through the interest and principal payments on its investment portfolio. The company invests in a range of RMBSs, including agency and non-agency securities, which are backed by a pool of residential mortgages. TWO strategically selects these investments to achieve a balance between risk and return, aiming to generate stable income and capital appreciation. In addition to RMBSs, TWO also invests in MSRs. MSRs represent the right to service mortgage loans on behalf of third-party owners. The company earns fees from servicing activities such as collecting loan payments, managing escrow accounts, and facilitating loan modifications. MSRs provide TWO with a steady stream of recurring revenue as long as the mortgage loans remain active. To enhance its profitability, TWO employs various strategies. The company actively manages its portfolio by monitoring and analyzing market conditions, interest rate trends, and credit risks. Through asset allocation, hedging, and trading activities, TWO seeks to optimize its risk-adjusted returns and capitalize on market opportunities. Furthermore, TWO engages in financing activities to support its investment operations. The company may borrow funds through repurchase agreements, credit facilities, or the issuance of debt securities. These financing arrangements enable TWO to leverage its capital, enhance its investment capacity, and potentially increase its returns. Risk management is a key aspect of TWO's business operations. The company employs sophisticated analytics and models to evaluate the credit quality, prepayment risks, and market value of its investments. Through prudent risk management practices, TWO aims to mitigate potential losses and maintain the stability of its portfolio. Two Harbor Realty currently yields a 19.5% dividend on a $12.29 share price. TWO's dividend has been slipping over the past 10 years, dropping from $8.88 per share in 2014 to the current distribution of $2.64. This has come alongside a massive decline in share price as well. In 2014, Two Harbor's share price was $67.13 and has declined at a 15% pace since then. Payout ratios have been fairly high historically, but as of their last reporting seemed much safer, sitting at 60% on free cash flow and 112% on net income. Things don't look too good for Two Harbor's income metrics. All income metrics except for free and operating cash flow have been declining at nearly a 10% pace since 2014. Despite the warning signs, some financial analysts are reporting massive upside potential for the REIT. Keefe, Bruyette, and Woods issued a market perform recommendation and price forecasts estimate a 40.75% upside on the stock. Next is Armor Residential REIT, ARR. ARR is a real estate investment trust that primarily focuses on investing in residential mortgage-backed securities. The company's business operations revolve around the management of its portfolio of agency-backed RMBSs, generating income through interest payments and capital appreciation. As a mortgage REIT, ARR invests in RMBSs that are backed by residential mortgage loans guaranteed by government-sponsored entities, such as Fannie Mae and Freddie Mac and Ginnie Mae. These securities represent a pool of mortgage loans, and the interest and principal payments on these loans form the basis of ARR's revenue. ARR's investment strategy involves seeking to generate attractive risk-adjusted returns by investing in a diversified portfolio of RMBSs. The company carefully selects RMBSs based on factors such as credit quality, prepayment risks, and interest rate sensitivity. Through a disciplined approach to portfolio management, ARR aims to optimize its investment performance and deliver value to its shareholders. The primary source of revenue for ARR is the interest income earned on its RMBS investments. As homeowners make mortgage payments, ARR receives interest payments from the underlying mortgage loans. This revenue stream is bolstered by the agency backing, which reduces credit risk and enhances the stability of the cash flows. ARR also engages in hedging strategies to manage interest rate risk. Interest rate swaps and other derivative instruments are utilized to protect the portfolio from adverse movements in interest rates. These strategies help mitigate potential losses and stabilize the net interest spread, which is a crucial component of ARR's earnings. Additionally, ARR may utilize repurchase agreements and other short-term borrowing arrangements to finance its investments. This leverage can enhance returns but also introduces certain risks associated with borrowing costs and market volatility. Risk management is a key aspect of ARR's operations. The company employs rigorous credit analysis and risk assessment techniques to evaluate the quality and performance of its RMBS portfolio. By monitoring market conditions, interest rate movements, and credit risks, ARI aims to mitigate potential losses and protect shareholder value. ARMOR currently pays a 96-cent dividend on a $4.85 share price for a total yield of 19.8%. ARMOR pays their dividends monthly, which can be attractive to investors, but ARMOR's payout history has been highly suspect. First off, the dividend has been declining at over 20% per year for the past 10 years. At the same time, ARR paid a dividend with negative net income for 7 of those 10 years. Income growth is variable. Net income has grown nearly 7% per year, operating income has grown on average of 13% per year, but free and operating cash flow have declined at over 8% per year for the past 10 years. It's important to note that although the overall trend is up for net income and operating income, ARR has reported negative income along all metrics several times since 2014. All this is reflected in the current share price, which has hit rock bottom. It's possible that this company will turn it around either by hiring new management or changing their strategy, in which case a buy right now would look like a stroke of genius. Next is Brandywine Realty Trust, BDN. BDN is a real estate investment trust that specializes in the ownership, management, and development of office and mixed-use properties. The company's business operations revolve around creating and maintaining high-quality commercial spaces to attract tenants, generate rental income, and drive long-term value for its shareholders. BDN generates revenue primarily through rental income from its portfolio of office and mixed-use properties. The company strategically acquires properties in prime locations within major metropolitan areas. By owning properties in desirable markets with strong demand for office space, BDN can attract a diverse tenant base and achieve stable rental income. The company's business operations also include leasing and property management services. BDN actively markets its properties, negotiates lease agreements, and maintains tenant relationships. By providing excellent customer service and ensuring tenant satisfaction, BDN aims to retain tenants and maximize occupancy rates, resulting in a steady stream of rental income. BDN's development and redevelopment activities play a significant role in its business operations. The company identifies opportunities to enhance the value of its properties through renovations, expansions, and repositioning. By investing in property improvements and incorporating modern amenities, BDN can attract higher quality tenants and command higher rental rates, ultimately increasing its revenue and property values. Additionally, BDN may engage in selective property acquisitions and dispositions to optimize its portfolio. The company evaluates potential acquisitions based on their strategic fit, potential for value creation, and alignment with its long-term objectives. Conversely, BDN may sell properties that no longer align with its investment strategy or present opportunities for value enhancement, allowing it to redeploy capital for more promising investments. Risk management is an integral part of BDN's business operations. The company employs comprehensive risk assessment and mitigation strategies to manage potential risks associated with market conditions, economic downturns, and tenant creditworthiness. By closely monitoring market trends and maintaining a diversified portfolio, BDN aims to mitigate risk and preserve shareholder value. BDN currently yields a 20.9% dividend on a $3.64 share price, paying 76 cents per share annually in dividends. This dividend has been growing at a steady rate of 3% per year since 2014, increasing every year from 2014 to 2020 and remaining flat since then. The stock typically wouldn't make it onto a list like this, but the share price has sharply declined since 2021 from $13.63 per share to the current price of $3.64. Since Brandywine has maintained their dividend during this period, the yield has skyrocketed from just 5.6% to over 20%. Financial growth has been pretty decent as well. Net income has grown 14%, cash flow up 2% per year, and free cash flow has trended upward at about 11% per year since 2014. Although free cash flow is increasing, they have reported negative free cash flow 6 of the past 10 years. Payout ratios on net income are higher than I would have expected for a REIT, climbing as high as 1100% and typically falling around 300%. That being said, payout ratios on operating cash flow typically land around 70%, which is well within my safety margins. There's a lot of confounding information in this analysis. I'm not sure why the stock price has dipped so strongly over the past 2 years, but this has caused a huge spike in the yield. Despite the dip, Truist Securities maintains a buy recommendation and forecasts suggest a 55.05% upside on the stock. Last on our list is Hudson Pacific Properties, HPP. HPP is a real estate investment trust specializing in owning, operating, and acquiring office, media, and entertainment properties, primarily in select West Coast markets. Hudson Pacific Properties has established itself as a prominent player in the real estate industry, providing investors with an opportunity to participate in the commercial property market. As a REIT, HPP generates revenue primarily through rental income. The company owns and leases a diverse portfolio of properties, including office buildings, sound stages, and production facilities. By leasing these properties to reputable corporate tenants, media companies, and entertainment industry players, HPP derives steady cash flows and income from long-term lease agreements. HPP's strategic location choices in major West Coast markets such as Los Angeles, San Francisco, and Seattle contribute to its success. These cities are known for their thriving business environments and robust entertainment industries, ensuring a steady demand for office and media spaces. HPP capitalizes on the high-demand nature of these markets, attracting quality tenants and driving rental income growth. In addition to rental income, HPP engages in development and redevelopment activities to enhance the value of its portfolio. By transforming underutilized or outdated properties into modern, attractive spaces, HPP can increase rental rates and attract high-value tenants. The company's focus on developing properties that align with market trends and tenant needs allow it to capture additional revenue and create long-term value. HPP also pursues strategic acquisitions and dispositions to optimize its portfolio. By acquiring high-quality properties in desirable locations and divesting non-core or underperforming assets, the company can enhance its overall portfolio quality and generate profits through property appreciation. Furthermore, HPP leverages joint ventures and partnerships with institutional investors, developers, and industry participants to undertake large-scale projects and gain exposure to new markets. These collaborations provide access to additional capital, diversify risk, and unlock new revenue streams, further bolstering HPP's financial performance. Hudson currently pays an even $1 per share with a share price of $4.59 for a total yield of 21.8%. Like BDN, the stock price has dropped sharply over a short time frame, sinking from $20.80 per share in 2022 to the current price of $4.59. Hudson has had impressive dividend growth since 2014, doubling it from 50 cents per share to the current distribution of $1 per share. You would think this increase would spike payout ratios, but ratios on operating cash flow have remained below 80% for 10 years, typically less than 60%. Financially, HPP has grown free cash flow by 9% per year, operating income by 13% per year, and operating cash flow by 15% per year. That being said, net income has declined 13% per year since 2014, and there have been numerous reports of negative free cash flow over the same time frame. To me, this looks like a pretty decent REIT trading at a massive discount. HPP's management is obviously focused on generating cash flow from their investments given the strong operating cash flow numbers. That being said, the wizards over at Goldman Sachs reiterated their sell recommendation just a couple days ago, despite a 67.72% upside from analyst price forecast. Thanks for watching. If you enjoyed this video, make sure you drop us a like and leave a comment to let us know what you think. If you want more videos on dividend stock analysis and dividend trading strategies, subscribe to the channel and turn on notifications. For another one of our videos analyzing dividend stocks, click on this video here. Till next time, stay safe and take it easy.